Hey there, fellow humans. Let's talk about money. More specifically, let's chat about how we got to this point where little rectangular pieces of paper, or, numbers on a screen, dictate our lives. It's fascinating to think about, isn't it? How do we go from trading tangible goods to relying on abstract concepts like digital currency? Believe it or not, there was a time before money. A time when people bartered for goods and services. Picture a bustling marketplace filled with people trading everything from livestock to handmade crafts. Imagine wanting a new clay pot, but all you had were chickens. You'd have to find someone who not only had a pot but also wanted chickens in return. It sounds simple, but it was far from it. You'd have to find someone willing to trade their pot for, well, poultry. Bartering worked, kind of. It was a system based on mutual need and negotiation, but it had its limitations. It was messy and inefficient. The process could be time-consuming and frustrating, especially if you couldn't find someone who wanted what you had to offer. What if the pot maker hated chicken? Or what if you had something even less desirable, like a broken tool or spoiled food? The limitations of bartering were glaringly obvious. What if you had nothing someone wanted? Enter money, stage left. The invention of money was a game changer. It provided a common ground for trade, something everyone could agree on. Early forms of currency like coins emerged, making trading much smoother. These coins were often made from precious metals, giving them intrinsic value. No more chasing after someone with a live chicken, begging them to take it in exchange for a slightly chipped pot. Coins could be used to buy anything, from food to tools, making life a lot easier. This new invention, money, was revolutionary. It simplified transactions and allowed for the accumulation of wealth, which was previously difficult to achieve through bartering alone. It acted as a common medium of exchange, a way to measure value, and a store of value. These three functions of money transformed economies and societies. Suddenly, you didn't need a flock of chickens to buy a pot. You could simply use coins, which were universally accepted and much easier to carry around. You could use these shiny new coins instead. They were durable, portable, and divisible, making them a perfect solution to the problems of bartering. And just like that, the world of finance took its first baby steps. From those early days of bartering to the complex financial systems we have today, money has been at the heart of it all, driving trade, innovation, and progress. Coins were cool, but have you ever tried carrying a sack of them around? Talk about inconvenient. Imagine trying to buy a loaf of bread with a bag full of metal. It wasn't just heavy, it was also risky. Thieves could easily spot you, and the clinking sound of coins was like a beacon. Plus, counting and making change was a hassle. That's where paper money came in. Instead of lugging around heavy metal, people could carry lighter, more convenient paper notes. These notes were easier to handle, store, and transport. They revolutionized trade and commerce, making transactions smoother and faster. But this presented a new challenge: trust. Who could guarantee that this paper was actually worth something? People needed assurance that their paper money had real value. This is where the concept of backing currency with precious metals like gold and silver came into play. Enter banks, those majestic institutions we both love and love to hate. Banks became the trusted entities that could guarantee the value of paper money. They issued banknotes that were backed by their reserves, giving people confidence in the currency they used. They became the custodians of our money, issuing banknotes backed by their reserves. This system allowed for a more stable and reliable form of currency. People could deposit their coins and receive banknotes in return, knowing that these notes were backed by the bank's reserves. This meant you could deposit your hard-earned coins and receive paper money in return, which you could then use to buy things. It made everyday transactions much more convenient and efficient. Of course, banks didn't just hold on to everyone's money for free. They were in the business of making money too. They started lending out deposited funds to borrowers, charging interest in the process. This was the beginning of the modern banking system as we know it. They started lending out deposited funds to borrowers, charging interest in the process. This practice allowed banks to generate income and grow their operations. It also provided people and businesses with the capital they needed to invest and expand. This concept of lending and interest became a cornerstone of the financial system. It enabled economic growth and development, allowing businesses to thrive and individuals to achieve their financial goals. It allowed businesses to grow, people to buy homes, and, well, banks to make a tidy profit. The banking system became an integral part of the economy, facilitating trade, investment, and wealth creation. It wasn't all sunshine and roses, though. Just ask anyone who's ever been denied a loan or faced a mountain of credit card debt. The banking system has its flaws and challenges, and not everyone benefits equally. But despite its imperfections, it remains a crucial component of our financial world. As businesses grew larger and more complex, they needed new ways to raise capital. The traditional methods of borrowing from banks or relying on private investors were no longer sufficient for the ambitious growth plans of these burgeoning enterprises. This led to the birth of the stock market, a wild and wonderful world where companies could sell shares of ownership to the public. It was a revolutionary idea that transformed the way businesses operated and expanded. Suddenly, anyone with some spare cash could become a part owner of a company, sharing in its profits or losses because life is a gamble. This democratization of investment opened up new opportunities for wealth creation, but also introduced new risks. The stock market was like a giant casino, but instead of betting on red or black, you were betting on the success or failure of companies. Investors had to navigate a complex landscape of market trends, economic indicators, and corporate performance metrics. It was a roller coaster ride of booms and busts, fortunes made and lost overnight. The volatility of the market could be both thrilling and terrifying, with dramatic swings in stock prices reflecting the ever-changing fortunes of the companies they represented. Remember the Dutch tulip mania? People were trading their houses for tulip bulbs. This early example of a market bubble showed how speculation could drive prices to irrational levels, only for them to come crashing down. Spoiler alert, it didn't end well. The collapse of the tulip market left many investors in financial ruin, serving as a cautionary tale for future generations about the dangers of speculative bubbles. Despite its risks, the stock market became a vital part of the financial system. It provided a mechanism for companies to access the capital they needed to grow and innovate, while offering investors the potential for significant returns on their investments. It provided companies with access to much-needed capital and gave investors a way to grow their wealth. The stock market became a key driver of economic growth, enabling the funding of new ventures and the expansion of existing businesses. Of course, it also led to some pretty spectacular meltdowns, proving that when it comes to the stock market, what goes up must eventually come down. The history of the stock market is filled with stories of dramatic rises and falls, reminding us of the inherent risks and rewards of investing. Fast forward to the 20th century, and a shiny new invention revolutionized the way we spend money: credit cards. No longer did you need to carry around wads of cash or even write checks. With a simple swipe or later a tap, you could buy just about anything. It was magical, it was dangerous, it was both. Credit cards offered convenience and a sense of financial freedom. They also made it incredibly easy to spend money you didn't actually have. This led to a surge in consumer debt, as people racked up balances they struggled to repay. The credit card industry, of course, was more than happy to oblige, charging hefty interest rates and fees. Credit cards, like many financial innovations, were a double-edged sword. They made life easier but also fueled a culture of instant gratification and debt. The lesson here: use credit cards responsibly, or they might just use you. Remember the days of actually going to a bank, waiting in line, talking to a teller through bulletproof glass? Feels like a lifetime ago, right? That's because the internet came along and changed everything, including the way we bank. Online banking made our financial lives infinitely more convenient. We could check our balances, transfer funds, and pay bills with just a few clicks. No more frantic trips to the ATM on a Sunday night. This shift to digital banking also paved the way for new financial technologies, or fintech, to emerge. Suddenly, we had apps for budgeting, investing, and even getting loans without ever setting foot in a bank. The financial world was becoming more accessible, more efficient, and, dare we say, a little bit cooler.